Deepika Asthana, your host for this session. And on behalf of Outlook Money, I'm delighted to welcome Mr. Mayuk Datta, Head of Product, Strategy and Communication at Mirae Asset Investment Managers, India. The biggest question on the minds of investors today is what to do next and where to invest and how to invest, especially in the backdrop of the current volatile, uncertain, complex, and ambiguous, basically the VUCA world. In such a situation when markets are extremely volatile, and of course, since the beginning of the year, we've been seeing very sharp corrections as well. Inevitably, you as investors would think about what should I do, where should I invest, and for how long should I stay invested in this market, right? Now, navigating through these unknown waters requires adapting to the changing tides rather than just, sticking to a fixed charted course. And in the investment world, of course, adaptation is key to survival, which is why it's important to understand that asset allocation in portfolios should be dynamic rather than static in nature. And of course, being in the right asset class at the right time can make all the difference to your investment portfolio. Keeping that in mind, the dynamic asset allocation or balanced advantage category of mutual funds in India addresses a lot of these challenges. So today in this webinar, we're going to learn more about the dynamic asset allocation series in the mutual fund space. I am Deepika Asthana, your host for this session, and on behalf of Outlook Money, I'm delighted to welcome Mr. Mayuk Datta, Head of Product, Strategy and Communication at Mirae Asset Mutual Fund. Welcome, Mr. Datta.
Thank you, Deepika. Thank you for having us here. Pleasure.
So just a little bit about Mr. Datta. He has been associated with Mirae Asset Mutual Fund for over 12 years and has rich experience in sales, business development, account management, credit appraisal, receivables management, vendor creation, and management. So I'm looking forward to this very interesting conversation now, Mr. Datta. So I'm just going to start right off the bat. Could you explain to us how a balanced advantage fund works?
Okay. So think about it in a manner that we have some other equity funds which have a free mandate to invest in across market capitalization. So within the equity space, you could probably invest into different sorts of companies, and that's how those mandates have been given by the rule. Same when it comes to asset allocation, there are different sorts of products which have certain limits in terms of what could be their exposure be in a specific asset class.
Sure.
So we have, in that sense, a balanced advantage fund or a dynamic asset allocation fund, and both are actually meaning same when it comes to the name of the schemes. Their objective is same. They are allowed to invest into any of the asset classes as per their scheme objectives and scheme informations as they are allowed, and they could invest across asset classes. So you could have a flexi cap equity fund which can invest across market caps. Think of this as a flexi asset product which can invest into different asset classes at any point of time. Yes, it would have certain limitations in terms of where it can invest, how much it can invest, but overall it can invest across asset allocations. So that is why the word dynamic asset allocation, or the other word could be balanced advantage fund. So they can invest between, for example, it could invest into debt, equity, arbitrage, and can move from one asset class to the other. And of course, each one, we can go a little bit deeper into it, but broadly, it can go through different asset classes as per the rules which are set when you launch a fund or how you run a fund.
That's interesting to know, Mayuk. And I think this term, which I don't know if you've been using it more frequently elsewhere, but flexi asset class, that's a very interesting way of summing up what exactly a balanced advantage fund is, right? It's across asset classes. So that's interesting.
Yes.
But I think from an investor perspective, maybe we can also discuss a little bit about how exactly will a balanced advantage fund add value to investor portfolios, and specifically if we could discuss this from the perspective of managing volatility, achieving goals, things like that.
Okay, sure. So let me start a little bit of the last question and then I'll come into here. What is important in that when you have an investment product, a fund which can invest into different asset classes, the way it manages would be dynamically. So that's the difference between a dynamic stroke balanced advantage category vis-a-vis other such products which are available. There is something called, let's say, as a balanced fund. just a balanced fund. There is something which is called as an equity savings category. There is something called as an aggressive hybrid category. All of them have the objective where they can invest into more than one asset classes, but the degree of their participation is different. So here in Balance Advantage Fund, how is it different from the others which can also invest under different asset classes, is that here it is managed dynamically. So a fund manager, depending on certain rules and his views or a model about how they should move from A asset class to B or vice versa or to C. So how this category is slightly different from the others is that here is a model or a thought process or a way of managing a fund which is dynamic. So you could have a situation that at some point of time, depending upon where the markets are, it could be debt, equity, or wherever, a fund could be highly into equity invested and therefore lesser into debt, just for example, and could on the reverse, when the markets were to give a different indication, could be heavily invested on the debt and be lesser on equity. So now this is being actively managed. So that's where a dynamic asset allocation or a balance advantage fund operates in. How does it help an investor? Which was your question. How it helps your investor is that when markets are going through certain volatility or are moving in a certain measure or in a certain band, the fund manager is able to take the call of moving out of debt or moving into equity or into arbitrage, or if there is something else also allowed, so dynamically manage it. So if markets were to, let's say, markets were supposed to be, let's say, being overvalued by some metric, then probably you can reduce the equity allocation in this fund and increase on debt, or when markets look choppy or when probably people would not be investing in, maybe the fund manager then increases the equity allocation. So this number is being dynamically managed. What it helps the investor is they are able to get a certain amount of participation on the equity side. But during the volatile times, if the fund managers were taking some strategies and reducing their equity positions, they are also getting an experience of lesser volatility. So by actively managing it, you are having a strategy which moves as per the times or the way markets are behaving. Sometimes investors would like to do it themselves, but if they are, but there are sometimes when the fund is also able to do it. And if you like that strategy, you can then invest.
So actually, honestly, Mayuk, that's exactly what, when we read about the dynamic asset allocation fund, right? One of the things which everybody talks about is how it can also help investors combat behavioral biases. Because a lot of these actions in terms of buy low, sell high, or stay invested in volatile times at individual investor level becomes very challenging. So from that perspective, I just thought we could probably discuss a little bit about how exactly the dynamic movement or the switch between equity and debt happens. Maybe a little bit about trigger points, just to highlight that the emotional and the behavioral biases can be proactively managed through this fund.
Sure. So what was earlier known as greed and fear has now become greed, fear, hope, and ignorance. So that's how it has got extended. But your point is absolutely valid. That many times the behavioral biases or over allocation, under allocation comes in with greeds and fear as markets operate, and there is nothing unnatural about it. It's very much possible. So how does a balance advantage fund tries to achieve that is by able to do the exact thing which probably some individuals are unable to do because they have other things to do, and the fund should be able to do this allocation on their own, which is buy when markets are low, increase the allocation with the stated objective that there is an end point also, that when markets look to be high, probably reduce some of that position on the equity side and bringing back to equity. So what you are trying to do is that eventually when markets were to go down, your equity exposure is lesser. So therefore your experience becomes slightly not as extreme as it would have been if you were more tilted on the equity side. Now, individuals doing it for each of their schemes and then moving and others comes at a cost. First, your call has to be right. You have to go through a process of exiting and then probably buying. The timing should be right. There is a tax angle to it when you move out of a fund or an asset class, come back and so on. So there are many other things which, and whether you are actually able to do it. So
Right.
all of these do not make it easier for the investor, and therefore there is this behavioral angle which comes into it. A fund, when it is following a certain rules or some investment objectives, is able to probably do it because it is doing it as a fund and it is doing for everybody. So the fund is behaving in that manner, which is by buying low and selling high, and then taking the calls in between during this process. So what you are exactly doing is what possibly could have been done individually, easier said, doesn't happen so much. We are all busy and have other objectives in life. So then the fund is probably trying to do some of that objective on their own. So that is where this comes in. The trigger points, as you said, could be anything. It could be market valuations. It could be any of the metrics which you see daily to measure whether markets are looking good, bad, or whichever way, but that's an opinion. So overall, there are many other ways by which many funds use certain metrics. They have their own models to say, by which they come to a conclusion that whether they should be buying more or reducing or just staying where they are on their allocations to different asset classes.
So then, Maya, would you say that from an investor's perspective, it's also very important to understand this particular strategy that is being the dynamic movement, the asset allocation strategy per se that is being followed by the fund. It's important to focus on that a little bit, that how is this switch happening? Because like you said, every fund does it differently or can do it differently.
Yes. So difficult question, because from an investor's point of view, to be able to delve into each scheme's model, understand the metrics, and then see which metric suits them better is slightly difficult. And I agree with you, it becomes difficult to be able to do that. So therefore, a way to compare funds or to find which one is better, I think it is always good to go back to the basics, which is to see that has the fund, whatever model it has used, is the user experience in line with what my objectives are. Only looking at returns or point to point is possibly not the only way of doing it. That is also a part of the decision making. But to look at it, it becomes slightly difficult. I agree, because there are models. Everybody is trying to basically have the same objective, but their paths are different because each scheme's model is different. But that is one of the ways of looking at it.
That is
not
very
only
helpful. That is very helpful, Maya, what you just said. That I think for this category, and I think largely also with any mutual fund investment, just to understand whether the fund is remaining true to mandate and delivering is not just in terms of return, but like the stated objective, that is something that investors can easily look at and must look at, right? So that is very helpful. So I just have one very overarching question for you now. One, just a little bit, just to educate our viewers, the importance of course, asset allocation per se in the larger investment financial planning journey. And of course, can we assume that the asset allocation fund, this dynamic asset allocation fund, can serve as a one-stop solution for investors?
I wish it was that easier, but it doesn't work in that manner would be our opinion, and I'll illustrate why.
Certainly.
An asset allocation is a subdivision of something which is your investment goals. So I would, as an individual, have different investment goals. Some could be for the next month, some could be after 6 months, a year, or 3 years, and some could be long-term, 5 years, 10 years, eventually a retirement as an individual's goals. So each plan will have a different subset of each requirement will have a plan, and each plan should have an asset allocation. To say that one asset allocation fund will be able to overarch all the requirements which are probably for next week till up to 30 years down is a little too much, because there are many variables which are in play. Very simple. If I need a money after probably 2 months also, I don't think so. And if I have to keep that money away, then my plan should be such that it has easily access to that money. It cannot be a growth asset. It would be somewhere which is a parking lot product, just to give it in a perspective. But if there is something which is beyond 5-10 years, probably it will have a mix of assets. So there the asset allocation is actually working there, because all paths will lead to that goal, investments. So what does such a dynamic asset allocation product gives? See, the fund is doing dynamic asset allocation. What you are getting as an investor is a participation rate. So your fund could be 15% in equity, 30, it could be 30% debt, 40% equity. So what you are getting is a participation number. A scheme per se doing asset allocation for thousands of investors is slightly difficult because different investors have different requirements. So your plan is unique to yourself. So your requirement demands a plan, and your plan therefore is divided into asset allocation. And as I said, different goals, different plans, so different asset allocation. So how can one scheme do it for everybody? What the scheme therefore gives you a middle path that for a certain amount of participation on equity, downside and upside, as I mentioned, you will be able to address some of the goals. But a scheme doing asset allocation for everybody doesn't work. But what this category does is possibly gives you a middle path, that you are getting a downside protection, you're getting an upside participation. Therefore, it is in a certain bandwidth. That bandwidth can address some goals which could be long-term also and short-term. But it will replace every other asset allocation, and it will override everything. It's debatable to say that only one scheme will address all problems. What it gives you a certain participation rate. Is that participation rate enough to reach your goals? You can then work it out accordingly.
Perfect. Thank you for distilling that, because sometimes the name suggests because our viewers would also like to know that just because the name suggests, like you very clearly said, it doesn't necessarily mean that it will act as a one-stop destination, simply because different investors have different goals, time horizons, and risk profiles. And of course, for a single investor as well, over a period of time, it changes, which actually, as we close, this brings us back to our initial thought process that asset allocation should be dynamic in nature, not static in nature.
Yeah,
and
absolutely.
thus, over a period of time, it should keep changing. So thank you, Mayuk. I think with this, we come to the end of today's episode of Investment Made Easy on dynamic asset allocation, spearheaded by Mirae Asset Mutual Fund. Thank you, Mr. Datta, so much for joining us today.
Thank you, Deepika. It's a pleasure. Thank you to you and your team.
Likewise. Thank you. And
Thank you.
Viewers, we hope you have enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. And you can also share your suggestions and questions at editor@outlookmoney.com. And we'll be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money, your favorite personal finance magazine. Thank you very much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.